Welcome back to Echo Trade. It's Jeff Roth, and we're here with Joe Hosler from Auour Investments, coming up to us from Massachusetts, opposite sides of the country. I'm down in San Diego. Joe's all the way on the other side, but Joe's got 30 almost 30 years of experience, mostly in institutional investment management. He was one of the founders of Auour Investments, coming up on 10-year anniversary today, I believe. And prior to that, 20 years of institutional investment management experience, managing up to $2 billion in assets himself. I think the team was managing about 10 billion collectively. But yeah, so we're appreciate having you. Thanks for taking some time, Joe.
Well, thank you.
Yeah, so today we're talking about the downside mitigation global equity portfolio from Auour and Joe, available on Echo Trade. So I always like to start with just kind of give me kind of the broader goal of the portfolio. What are we trying to accomplish? Kind of what's kind of your kind of monetary thesis within the portfolio.
Yeah, so the reason the genesis for starting this company up was the three founders. We were all money managers, but targeted a certain type of style of investing. We worked at different mutual fund houses and such, Putnam, Pioneer, and others, where we were tasked with, and specifically, I was tasked with small cap growth. So small companies growing strong. But if you didn't like that segment, if you couldn't find anything of value, you weren't able to deviate into other areas. And
you specifically as the portfolio manager.
Yeah, and you had to be fully invested. So it was something that was hard for us to grasp, because we felt like each asset class is becoming very efficient, but how people blend those asset classes is where the inefficiency lies. And most of the mutual fund houses and most of the investment houses right now still focus on trying to work just on that asset class and not think about a global portfolio and how it should be structured in different type of regimes. So we've been an innovator in something called regime-based investing. It's this idea that markets go through cycles, and those phases within those cycles, if you can tune the portfolios to embrace that phase, you will outperform over the long term. And for us, it's also about outperforming by not going down as much. So we have a targeted or an aim of trying to produce market-like returns, but suffer less than half of the drawdown, or around half of the drawdown that the market goes through. That means drawdown is from maximum price to minimum price within the cycle. So let's look at the pandemic being one of them. The U.S. equity markets and the global equity markets were down about 40% over that time, during a very short time period because of the pandemic. We were defensively positioned going into that for other reasons, not because of the pandemic, but that allowed us to only capture 20% of the downside and be more prepared for coming back into the market, having dry powder to move it back into the market. So this idea of regime-based investing is something that's came about after the global financial crisis, when the world looked like it was ending. There was very little protection in a statically diversified portfolio. So that's where we came about in 2013, saying, look, let's look at this in a different light. Let's try to figure out if we want to participate in the market, and if so, how much. And based off of that and our analytical approach, we've been able to understand the risk appetites and the changing risk appetites within the markets, and to tune the portfolios accordingly.
That's interesting. Yeah, I mean, so the goal again is to participate in the upside for the majority of that, but to mitigate risk on the downside and only participate in a portion of that. And that's important. I mean, I had a similar philosophy. I had a newsletter years and years ago. Very very straightforward, keep it simple, stupid analysis. Not nearly the experience and the intelligence of guys like Joe, but that was the goal, right? And it's a much more long-term vision for tackling the market, because if you're able to, like you said, only participate in 20% of the downside. So instead of losing, 40% of your portfolio, you lose 10%, and then maybe you don't get into the absolute bottom, but now your money, you have that much more money when you do get back in, that is compounding that much faster through the rise of the further upside in the rest of the bull.
Well, yeah. So Peter Lynch is one of the fathers of investing, modern investing. Peter Lynch ran the Magellan Fund at Fidelity. He had a 25-year track record where he outperformed the S&P 500, his benchmark, he outperformed by double. So I
Yeah.
think the S&P 500 was up on average 13% per year over that
Mhm.
time period, and he was
Yeah.
up something like 25.
Hmm.
But when they went back and looked and analyzed the portfolio, the performance of the portfolio of the, I'm sorry, of the participants in the portfolio, people would get scared out at the worst time and scared in at the worst time. And so
Yeah.
the realized return, even though the portfolio did really well over that time period, clients were trading it badly and they had half of the return of the S&P 500.
Yeah.
So the emotional swings that we go through, and it's understandable. I mean, this is our life savings that we're talking about. And when the market goes down quickly and you don't know why, you lose confidence in it. You lose confidence in your financial plan. You don't trust anything other than hard dollars. And so you sell out typically at peak point pain, at the peak pain point, which is near the bottom. So if we at our job is to try to take the emotion out of this, to try to drive a disciplined approach to understanding when you're going to get compensated for taking risk in the market and when you're not. And based
Yeah.
off of that, how much cash do we want to hold? How defensive do our position or do we want our positions to be versus how aggressive? And it's all about keeping people in the markets and trying to offer them a higher level of control over that. And we've experienced that through the last 10 years that we've been around. We've had an oil crisis in the 2016 time period. We've had the pandemic. We've had the worst bond market in the history of the world. So we've had a lot of scares over the last 10 years. And
Yeah.
based off of that, we've actually, I knock on wood, I feel like we've done a really good job of protecting that downside while still participating in the rising markets.
Yeah, no, I mean, it's a really good point that you're making there. And I think investors need to kind of understand this, especially when participating in a platform like Echo Trading, where this is not a day trading platform. We're not
No,
trying to, drastically outperform the market necessarily. We're trying to give access to guys and experts like yourself. And it's definitely if you're looking on a more of a long-term perspective, that maybe, like you said, the goal of the portfolio, I think is stated that you're only really looking to capture 90% of the upside of any bull market. So
right.
you're actually going to be underperforming if you're looking at it from that very short
Short
lens, even though that may be years that you're underperforming. But over the long term,
Underperforming.
you're going to be
Yeah.
drastically outperforming if you're able to accomplish the goals of 90% of capturing the upside and 50% of the downside. That's actually going to be outperforming by a significant margin.
Exactly. So for us, it's we call it another phrase that we use is strategically tactical, meaning
Yeah.
that we want to be like the market a large amount of time. And I guess here's some stats. If you go back and look at 6 month return windows of the S&P 500, you just look at how it's returned, how it's performed in a 6 month period.
Yeah.
80% of the time, it goes up. So you want to be in the equity markets. It's a
Mhm.
great near free way to be growing your money.
Yeah.
However, that 20% of the time that it doesn't go up, 10% of that is it's down over 20%. So 10% of the time that you're invested, you're going to be scared out of your pants that
Yeah.
you're losing money.
Hmm.
All we're trying to do is get you more of that upside while understanding that 10% of the time the market can really go down. There's
Hmm.
some common elements. And so if we can figure out those common elements and through our analysis decide when to mitigate that downturn or mitigate the risk so that you don't experience that full 20% down,
Yeah.
we think that we're going to win in the end. And so
Yeah.
far, we've shown that we've been able to do that.
No, that's great. And so, I mean, talk about the process of how you define, when to get in, when to get out, or when to kind of, reallocate the funds, determining based off of how you guys are viewing any particular market. So you have the Auour Regime Model, kind of proprietary algorithm
Yep.
that you guys mentioned. We call it the ARM. So talk about, kind of what goes into that, and what's determining kind of your asset allocation at any given moment.
Yeah, so the Auour Regime Model or risk model ARM is meant to be a multi-factor approach. So we cast a wide net. We want to see a lot of things to understand the changing attitude around investing within the market. So we're
Hmm.
looking at they kind of sit within four main buckets, the signals that we look at. And again, we're crunching numbers every night. Millions of data points are built into this model, and we run it every night to sense changes within the markets.
Because it's a quantitative model, so it's
yeah, very quantitative, and so it's rigorously back tested. So we feel it's been a great sense of stability within the firm, as well as for my own assets, because we manage our own money this way, and in these strategies. But they kind of sit with the signals that we're looking at, kind of sit within four aspects of the market. There's something momentum. So momentum's a great signal of future returns.
Yeah.
It's a great predictor 2/3 of the time. 1/3 of the time, it's the worst thing you could follow. And the way that I think about it is it's almost like driving a car by looking in the rear view mirror. Momentum is purely looking backwards. And if you're on the straightaway, that's fine. But if you happen to hit a hairpin turn, you're off the road.
Yeah.
And so that's the problem with momentum, is that it's backward looking. It's really good, but only 2/3 of the time. So how do we take the good aspects of momentum and blend it to be more forward looking? And that's where the other three aspects of the market, of the signals that we look at. Credit markets are really big for us. Fixed income markets typically lead the equity markets. And so if we can understand the cost of credit, or the cost of debt, the availability of debt, and the change in the price of debt. So three things that we look at very clearly. How much does it cost to borrow? Can I borrow? And how has it changed over the short-term period? So those are more forward-looking aspects of the market. Can the economy continue to grow if credit becomes hard to find?
Yeah.
And we blend that with valuation metrics. So price to earnings, price to revenue, price to cash flow are things that we look at. But valuation we look at as a risk measure, not as a timing mechanism. So the analogy that I use for this one is valuation's like a stretched rubber band. If you take a rubber band between your two hands and you don't stretch it, you don't know. And if you let go, you know it's not going to hurt.
Yeah.
However, if you take a rubber band and you stretch it to the extreme, you don't know when it's going to break, but you know the pain you're going to feel when it does.
Yeah.
So we look at valuation as a risk measure. So is it stretched? And if it is stretched, and if something changes, how much pain are we going to feel? And then the last component, the last bucket of signals, are what we call interaction factors. So interaction is we're sensing things around the globe: currencies, credit markets, stock markets. And when you start to see things coordinate or correlate, where something that happens in Italy starts to also seems to happen over in China, or something of that nature, when you start to see changes in the global markets that look like they're localized, but they start to become global, that's a concern for us that we need to be careful of.
Yeah.
So we blend all of those in to get to understanding the risk appetite in the market, and based off of that risk appetite, how much do we want to be fully invested? And if not, how much cash do we want to hold as dry powder for a expected volatility period that we can capture better prices?
Well, that's fascinating. There's like literally 100 questions that I could dive into on this, on what you just talked about. But in the interest of time, we'll just cover a couple of other things, but that's fascinating how you guys are going about that. And that's all put into, like you said, into a quantitative algorithmic model that you guys, like you said, you're running every single night, that you're spitting out information that's constantly updated, right?
Yes. Yep.
Yeah.
So we are constantly, and I guess I'd leave you just with one phrase. Warren Buffett has a phrase that is the way that I describe the algorithm that we've built. He says that he chooses to be fearful when others are greedy, and greedy when others are fearful. And that's the way our model looks to be. When people are taking excessive levels of risk, we want to dial our risk back, and vice versa.
So to wrap it up, I just want to kind of look at this. It sounds like this is more, we talked about, you have the Auour inflation fighter portfolio within Echo Trade as well. And so that there's a lot of characteristics, and investors can go take a look at that video and kind of look more into that portfolio. But it sounds like that's, at least the way you're managing money, which you're invested in all your portfolios, that it's more of a sleeve, like an outlier of a strategy within your broader portfolio. But it sounds like downside mitigation global equity is more of a core portfolio, if I'm hearing you correctly. And I believe you touched on earlier that in your previous life, you were stuck in a box with small cap growth. But this is, you're really looking globally at all geographies as well as all sectors and all company sizes. You're not just focused on large cap, mid cap, small cap. You're really agnostic on really you're putting everything into the algorithm, the Auour Regime Model algorithm, and then pouring that out. And so this could be a nice core portfolio. And so I put a lot in there, sorry, but I kind of wanted to wrap it up. It seemed like a good way.
Yep. No, we are a risk intelligent core manager.
Mm-hmm. Got it. Perfect. So a core portfolio, you can have the Auour Inflation Fighter as a bit of a sleeve, exactly, and look at the downside mitigation global equity as a core portfolio, which investors can take a look at, and they can copy all of the trades from Joe, copy the smart guys within Echo Trade. So Joe, I appreciate you taking some time.
Thank you.
Lots of insight. Thanks for being here.
Thank you so much.